Hello, this is Jordan, and this is your precious metals market update. This video is being recorded on the early morning of Thursday, November 30th, 2017. Thank you so much for joining me today. And in this video, I'm going to discuss my short-term bearish outlook for gold and the gold stocks. And starting off here, we have a daily candle chart for GDX and GDXJ. We can see that with GDX, we have the 50 and 200-day moving averages. For GDXJ, we have the 50-day moving average. That's well below the 200-day. And what we see here is that the gold stocks are on the cusp of a technical breakdown. Starting with GDX, in the last couple days, we can see that it failed at both moving averages, both the 50 and 200-day. A couple of days ago, it traded higher, but then closed much lower, so it formed a bearish reversal. I mean, we have 4 black candles in a row. That signals distribution, and the market has been holding above 2225 or 2240 in that area. It's been holding above it for about a month, and it had a sharp decline, obviously, from early September down to the end of October. Mark was oversold. It's needed about a month to work that off. I mean, maybe it still could work it off for a couple more days, but there is the threat of breaking that support. I mean, really in the next day or two. By the time you're looking at this, it could already be broken. And the same thing can be said for GDXJ, which has been weaker. It made a slight lower low in the middle of November, and now it's coming down to that point. So really, there's very little room here for the miners. I mean, another down day here, and they could break down. And with respect to GDX, I mean, a clear technical breakdown could take this down to support at $21. Whereas for GDXJ, it closed at 31.71. That could come down to around 29.50, which is the May low. There is some support around 31, and that goes back quite a ways. I mean, there's other key points that stopped at 31. However, given the consolidation over the last month, that's bearish price action, and that is going to I mean, you could do a bit of a measured target with between, it looked like it got close to 33 in early November, then with the low down around 31.5, so a measured target would take that down to 30, which is a little bit above the 29.50 target, the May low there. So I see a high probability, or a strong probability, that the miners are going to break down here and come down to these lows, but they would get even more oversold, and that could lead to a pretty good rebound into the new year, which I'll talk about more later. Now here we're looking at gold against foreign currencies at the top and then gold at the bottom, and I think the real big story for precious metals in 2017 has really been the weak performance of precious metals in the face of a very weak dollar. I mean, at one point, I think at the dollar's September low, it was down 11 or 12% year to date. I mean, that's a big move down. I mean, if you're in a real bull market, I mean, you would see big moves higher in the metals and miners, and it just did not happen. I mean, if you're basically, what that means is if you take out the dollar weakness, it really was a negative year for precious metals. I mean, not a real bad negative year, but they should have performed that much better. And we can see here, looking at gold against foreign currencies, how weak that has been in 2017. I mean, it peaked in April, whereas gold peaked in September. And we can see that gold against foreign currencies over the last 2 months, I mean, 1, 2, 3, 4, 5, 6 times it's tested the long-term moving averages there. So, I mean, that is setting up for a move lower, in my opinion. And there's key support right around that chart, around 55 or 56. So, I mean, gold against foreign currencies, that is not a bullish-looking chart. That is a very bearish chart that's very concerning. And so, the reason why gold has performed well this year has been the weak dollar. But in relative terms, gold has not had that good of a year because in the face of such dollar weakness, it should have performed that much better. So, and I mean, this goes back to a couple years ago. I mean, remember, there are many times when we pointed out, gold against foreign currencies has been strong, even though the dollar has been strong and gold hasn't done that well. I mean, that's a good sign for gold when you see that. you see that kind of relative strength. Right now, we're seeing the opposite. So this is a concern. Focusing on gold in U.S. dollar terms, I mean, it's kind of been consolidating the last couple months from around 1,300 to 1,260. There's strong support on the chart from roughly 1,200 to 1,215 or 1,220. So if gold breaks below 1,260, which I think it will, look for it to fall down to 1,220, 1,215. And, that could probably, obviously coincide with the low we talked about in the miners. So, yeah, I think I've said it all for gold and gold against foreign currencies. It's a bearish outlook right now. But finally, some good news. Now, this is something I wrote about a week ago, and this is something that I've been focusing on the last couple weeks for premium subscribers. And this data here, we're comparing recoveries from mega bear markets. And we define a mega bear market as, anything close to 3 years and over an 80% decline. And it's not always the case. I mean, there are some things that we didn't include here. For example, the gold stocks from 2000, that rebound was much, much stronger than the rebounds we see here. I mean, that just kept going up, up, and up for several years. But anyway, back to the here and now, the gold stocks obviously fit that bill of a mega bear market. The data is from the HUI, 84% over 4 years. But the pattern that these mega bear markets follow after they end is they tend to have a very strong rebound, but it's not very long in terms of time. I mean, it can be 6 months or a year. And that leads to a correction and then a consolidation, which typically lasts, well over a year. I mean, on average here, we're looking about 1.5 to 2 years. And then that eventually leads to another leg higher of a very strong move, which is like the first initial rebound. Now, in terms of Elliott wave analysis, I mean, if you're familiar with that, it's very simple. We're talking about, in terms of time, a very short wave 1 up, but then a very long wave 2, which eventually then leads to wave 3 and the strongest move. Now, the 3 best examples historically, which compare to gold stocks, are the S&P 500 after the Great Depression, the housing market after the last bear market, and Thailand after its huge bust in the mid-90s. And so the S&P 500, after it had that bottom in 1932, 87, well, actually, I'm getting that wrong. The bear market for the S&P 500, not quite 3 years, but almost 3 years, 87% decline. Then it rebounded 177%. Then it had the correction and consolidation, and that led to a 132% rise over 2 years. Housing, that was a mega bear market, lasted almost 4 years, down 81%, 137% rebound, then a 40+% correction, 1 year and 6 months. Then that led to it's still going up since then, but it led to over the next 18 months a 177% rise. Now, the interesting thing, there are some differences. Now, with Thailand, its correction, the price bottom of the correction was actually about 1 year and 4 months. But over the next 12 months, it had a rally, and then it came back and retraced most of that rally. So with Thailand, we're looking at the reason the time there is greater is because we mark the time when Thailand started its rebound and kept going higher and higher. And so over the next 2 years from that point, it was up 200%. Now the difference, that's another different. The correction in Thailand was obviously, it was worse than what we're seeing in the gold stocks now. But the correction in the gold stocks that we're seeing now, the correction and consolidation, it has been worse than what the S&P 500 and housing experienced. So those markets during the correction and consolidation, they showed more strength than what the gold stocks have been showing over the last year and three months. So to me, I'm really focused on the length of the correction in terms of time, and then the time between the bottom and then the next low. So the time between those two critical lows, the start of wave 1 and obviously the start of wave 3. And so gold stocks now are, this data is a little old, but they're in their 4th month, year and 4 months. They're getting into their 11th month So nearly 2 years of the time between, or the time since the first low. And if we focus on the correction, we can see that, those three examples, the S&P 500 housing, a year 8 months, a year 6 months. So gold stocks are 3, 4, 5 months away from that. But then if you look at the time from the first low to the second low, looking at those other examples, they show that there's potentially anywhere from, let's see, 9, 8, 9, 10 months, maybe a year. So, I mean, I based on this history, I mean, what I've been thinking is, we could see that this critical low anywhere from, say, 3 months to 9 months. My gut, in my gut, I feel like, the low is probably going to be, sometime next summer, because we know that you tend to make a look. I'm not big on seasonals, but obviously, or if you look at history, the gold stocks have had a lot of their best moves have been from the end of summer then into the end of the year. So it makes a lot of sense to me. And then just studying this and based on the time of the corrections, the time between the lows, I think you could see this critical low, at some point at the end of Q2 of next year, or maybe in sometime in Q3. And that doesn't, when I'm talking about the low, that doesn't necessarily mean a low in price. I'm just talking about the low when the next move up would begin, and it's a move that, it's a move like 2016, where it's an impulsive advance. It keeps going, it goes and takes out resistance. It makes higher highs and higher highs, unlike what we've seen over the last year, where it's just, you rally for a couple months and you go back down and you rally again. And looking, I mean, there's other examples here which follow. I mean, the banks in Ireland, their bear market didn't last that much more than 2 years, but they follow the pattern. The mortgage market follows the pattern. Their correction is a little bit longer than the other examples. Same thing with the solar market. The solar market, which has just started its next leg up, but obviously there's some different, there's different numbers in those cases. The solar market, that went down 95%, but then it rebounded 336%. So those numbers are a little different. So I like to focus on, again, the three best examples: S&P 500, housing, Thailand. And quite simply, what this tells me is that I think gold stocks are really setting up for a very strong second half of 2018 and then 2019. Now, finally, we always show this chart at the end of our videos. And, by the way, gold, we know that there's the resistance here for around 30 for GDX and 50 for GDXJ. And if these markets move up, take out these resistance levels, there's a lot of upside. And that coincides with the analysis I just mentioned in the last slide. But where we are here and now, these are the weekly bar charts. For GDX, there's really two key support areas. The first one is obviously 21, the recent lows in 2017. But if GDX breaks below 21, you could test that. December 16 low around 18. You could even go a little bit below it, and you could have a false breakdown. Same thing with GDXJ. Looking at the lows, 29.30 is the next support. Then there's a lot of support at the December lows, or a tiny bit below. 26, 27 possibly. So where we are here and now, my thinking is that we're probably going to move lower in the weeks ahead. Probably to the first levels of support, but then perhaps you get a rally in Q1. Then you get more weakness in Q2 and into the summer, and possibly lower lows, and then that could be the low when the market is setting up for that really fantastic second half of the year and really strong 2019. So that's what I see here and now. Obviously, not a good short-term outlook, but it'll probably lead to a rally, and after that, you really want to get ready to buy the next low. Now, you can follow all of my work at thedailygold.com. Consider subscribing to my premium newsletter. It's only $149 for 6 months. You can find that at thedailygold.com/premium. We focus on market timing and stock selection in the juniors. If you want to know which juniors have the goods and best potential, sign up for our service. It's highly affordable. And thank you again for listening and watching this video. I look forward to publishing another video update for you in the weeks ahead. Thank you.